Why do chart patterns sometimes look obvious on a chart but fail the moment someone tries to trade them? That question matters because many people learn technical analysis by memorizing shapes, yet the hard part is not spotting a pattern. The hard part is deciding whether the pattern reflects real buying and selling pressure or just random price movement that happens to resemble a familiar shape. A chart pattern is a recognizable formation in price, such as a triangle, head and shoulders, double top, flag, or range. In technical analysis, the idea is that repeated behavior by market participants can leave repeated shapes on a chart. For example, a series of lower highs and higher lows can form a triangle, suggesting that price is compressing and a larger move may follow. A double top may suggest that buyers struggled to push price above a prior high. The appeal is simple. Patterns offer a visual shortcut for thinking about trend, momentum, support, and resistance. Support means an area where price has previously found buying interest. Resistance means an area where selling interest has previously appeared. Momentum refers to the speed and strength of price movement. These concepts are useful, but the pattern itself is not a law of nature. It is a summary of past behavior, not proof of future behavior. So why do patterns fail? First, many patterns are subjective. Two people can look at the same chart and draw different trend lines, choose different time frames, or disagree on whether a pattern is complete. A formation can look clean on one chart and messy on another. That means the edge, if one exists, may be weaker than it first appears. Second, markets are noisy. Random price fluctuations can create shapes that resemble meaningful patterns. Humans are very good at finding order and randomness. That can be helpful, but it also means we can see a breakout, reversal, or continuation setup where there may be none. Third, context matters more than the shape alone. A bullish-looking pattern inside a larger downtrend may behave very differently from the same pattern inside a strong uptrend. A breakout during quiet trading may not have the same significance as a breakout accompanied by broader participation. In some approaches, traders use volume, meaning the amount traded as a clue about conviction. But even volume interpretation depends on the asset, exchange structure, and data source, so it should not be treated as universal. Fourth, chart patterns can become crowded. If many market participants watch the same level, price may briefly move through it, trigger entries or exits, and then reverse. This is sometimes called a false breakout, meaning price appears to break beyond a level but does not continue in that direction. Here is a simple decision framework for using patterns carefully. Start with identification, and what exact rules make you call it that. Then ask for context. What is the broader trend, volatility environment, and nearby support or resistance? Volatility means how much price tends to move around. Next, ask for confirmation. What would increase confidence that the pattern is behaving as expected? That might be a close beyond a level, a retest that holds, or alignment with another tool. Then ask about invalidation. What evidence would tell you the pattern is not working? Finally, ask about alternatives. Is this pattern giving information you do not already get from simpler methods? Hypothetical example. Imagine an asset trading sideways after a prior rise. You notice a triangle forming as the highs get lower and the lows get higher. One interpretation is that price is consolidating, meaning pausing before the next move. A careless approach would be to assume an upward breakout just because the earlier trend was up. A more careful approach would be to say, this pattern suggests compression, but direction is uncertain until price actually leaves the range. You might then compare multiple possibilities. If price closes above resistance and holds above it, the bullish case becomes more plausible. If price breaks lower and stays below support, the bearish case becomes more plausible. If price moves outside the triangle and quickly falls back inside, that uncertainty increases and the breakout may be unreliable. The key point is that the pattern does not tell you what must happen. It tells you what conditions to watch. Compared with other tools, chart patterns are visual and intuitive, but they are not always the most precise. Trend-following methods, such as moving averages, can be slower but more rule-based. Momentum indicators can highlight strength or weakness, though they also produce false signals. Support and resistance analysis is simpler, and sometimes captures most of the same information without needing to name a pattern. Fundamental analysis, which looks at business, economic, or financial drivers, addresses a different question entirely and may matter more depending on the asset and time frame. None of these methods is universally superior across all markets or periods. The main limitations are important. Pattern reliability can vary by asset class, time frame, transaction costs, liquidity, and market regime. Liquidity means how easily an asset can be bought or sold without affecting its price too much. A pattern seen in a highly liquid market may behave differently in a thin market. Backtesting, if done, can also mislead if the pattern rules are vague or if someone only remembers the patterns that worked. A practical takeaway is this: use chart patterns as a structured way to observe price behavior, not as standalone proof. Define the pattern clearly, demand context, plan what would confirm it, and decide in advance what would invalidate it. If you cannot explain why the setup might work, what would make it fail, and how it compares with simpler alternatives, the pattern may be adding confidence without adding clarity. This is educational content, not financial, investment, tax, or legal advice.